Next week's a busy week for the economic diary. We start off with a weekend release of China's economic data, including GDP, industrial production, retail sales. That's followed during the week by the flash PMIs for Markit, again from China, as well as the US and Eurozone. And we've also got UK labour market data. Starting with China, over the weekend we'll see economic data releases on GDP, industrial production and retail sales. GDP is the big one. GDP growth is expected to have slowed from 7.8% in the third quarter to 7.6% in the fourth quarter. However, perhaps more importantly will be what happens in the first quarter of the year. Now, Markit's PMI, which we produce for HSBC, that's published during the week, that fell to a three-month low of 50.5 in December. So everyone's going to be watching to see whether that index picks up again or whether there's signs of a further slowdown in China in the first quarter of the year. Whereas the rate of growth slowed at the end of last year, according to the PMI data, in the Eurozone it was a different picture. Markit's Eurozone PMI rose to a 2.5-year high in December. So this is painting a picture of a Eurozone that's slowly reviving. Rate of growth is only very weak, there's around 0.2% GDP increase, but nevertheless we're moving in the right direction. Now, the flash PMI for January will say whether that momentum continued to build at the start of the year. However, analysts will probably be watching the details within that more than the headline number. We've seen at the end of last year growing divergence between the performance of Germany and France. Germany, the rate of growth there is hitting a 2.5-year high, but in France we've got a downturn. This renewed downturn actually gathered momentum in December as well. So we want to see whether that divergence widened in January or whether we're going to see some narrowing. The other flash PMI that's released is the US manufacturing index. Markit's flash PMI hit an 11-month high of 55.0 at the end of last year. Now, that signalled a fairly robust end to the year, as we can see from this graphic. When you chart that index against manufacturing outputs, a very tight correlation was signalling a decent rate of growth around 2%. So this is in contrast to those weak non-farm payroll data. So this survey is suggesting that that disappointing non-farm payrolls number in December was a temporary aberration. We should pick up from here again. Even the survey's employment index signalled an increased rate of job creation at the end of last year. We'll know a lot more, of course, with that January flash number, whether those non-farm payroll data should pick up again and whether the US economy is on a firm footing. A robust number, of course, will increase the chance of a further Fed taper. Now, speaking of central banks, the Bank of England will be watching the official labour market data in the UK very closely on Wednesday. The rate of unemployment has fallen sharply. It's down to 7.4% in the 3 months to October. The flow of data that we've seen so far, including the business surveys, which are signalling job creation surging at the fastest rate since the late 1990s, suggests that the 7.0 threshold the bank's earmarked for considering higher rates could be reached imminently. By that we mean possibly even it could have been reached by the end of last year when the data catch up. So the Bank of England is going to be watching that unemployment rate very closely, but perhaps even more importantly, it's going to be watching the pay growth numbers. Now, the rate of pay in the UK has been disappointingly weak. It's running at only around 1%. We need pay to start to rise, grow at a faster pace to bring about a more balanced recovery. Now, any increase in pay growth will provide a further conundrum for the Bank of England as to whether it really should be keeping interest rates ultra low or start that tightening cycle. Further details of all of this and reaction to the data are available on Markit's commentary pages on markit.com.